Have you ever wondered why some people work their whole lives and still struggle financially, while others steadily build wealth over time? The answer often comes down to one simple concept: understanding the difference between saving and investing. Most people think saving and investing are the same, but they're not. If you don't understand this difference, you could be missing out on massive financial growth opportunities. In today's video, we'll cover what saving really means, what investing actually is, key differences, when to save versus invest, and a simple strategy anyone can follow. What is saving? Let's start with saving. Saving means setting aside money for future use. People usually save money in savings accounts, fixed deposits, cash. The main purpose of saving is safety and liquidity. For example, if you earn $1,000 per month and keep $200 aside, that is saving. Advantages of saving safe and secure. Easy access. No major risk. Disadvantages low returns. Loses. What is investing? Investing means putting your money into assets that grow over time. Common options: stocks, mutual funds, real estate, gold, bonds. The goal is wealth creation. For example, if you invest $200 per month with a 10 to 12% return, your money grows significantly over time due to compound interest. Advantages higher returns. Beats inflation. Builds long-term wealth. Disadvantages risk involved. Requires patience. Not ideal for short-term.